Hi there, 𝘄𝗲𝗽, Lauren Hall here from Low Market Edge, coming to you with our weekly wrap. Happy long weekend, firstly, for Queenslanders.
The sun's out, beautiful.
The sun is out, wicked storms last night, but the sun is back out today, which is great, just in time to be in the office for the weekend. And October, holy shit. Yeah, crazy how quick that has gone. So first quarter's gone. We are in the run home to Christmas, for those who haven't noticed. This year has moved incredibly quick. All very exciting, but yeah, very, very quick. So today, some topicals. What's trending in lending? Probably hot off the topic was really around some talk from 𝘄𝗲𝗽, the treasurer, the guy that has all the treasure, in relation to chatting with regulatory bodies, a lot of big words in here, regulatory bodies, and the regulators with APRA and all of these guidelines around your ASIC and your APRA and everyone that oversees, I guess, how lending works in the country and sets those guidelines. Just as the housing market continues to rise at the level that it is, they're looking at some ways to maybe try and slow that down a little bit. And some of the things they've been talking about, what they're actually looking into, have been really interesting. Yeah. So two of those was around DTI restrictions and LVR restrictions. Lauren, if you might like to explain DTI to the fans at home.
So DTI, we love a good, bank jargon acronym.
LVR and LMI and DTI.
Correct. So DTI is your debt to income ratio. So when the banks assess your borrowing capacity, they're looking at your income minus all of your expenses and outgoings, but they also look at the ratio of income to the amount of debt that you have. Okay, and there's a ratio or a calculation on that. So one of the things that the Treasurer has, I suppose, given the green light for the regulators to discuss, it's only discussion at this point, but to look at is around putting a cap on that DTI. So 99% of the banks and lenders already have a requirement around that. At the moment, that will be a debt to income ratio. So the amount of your income to the amount of debt you have can't be more than, well, anywhere between 6 to 8 times for the ones that have it. So they're talking about capping that at 6. So if you're earning 70,000 and your partner was earning 30, there's 100,000. Technically, you wouldn't be able to borrow more than 600,000, for example, because that's 6 times the amount of your income. So even if you were paying more than that in rent and you actually had surplus income, so from a borrowing capacity point of view, because interest rates are so low, you could show you could afford more than that, the debt to income ratio cap would still come in. So we see it a little bit, but there's definitely not a blanket rule at the moment that's coming from the regulators. The banks are able to dictate and determine that. So that will be a very interesting point of discussion.
I think you mentioned there as well earlier there, the key to that is around wanting them to have surplus household income. So why? What's the outcome? What are they hoping to achieve with that? Is they still want people to be able to borrow money and potentially buying in some more affordable areas, but being able to have a surplus. Yeah. So not just tapping out on the mortgage as per the way they've calculated it, and having some surplus income if there was to be, that rise potentially in interest rates. So that for them is a way just to slow that down a little bit, so people suddenly 1, 2, 3, 4 or potentially borrowing more than what they want up front. There's a goal that they're trying to achieve. And a little bit of balance, responsible lending. I don't think 6 is a bad idea. And again, it's been adopted by a lot of the banks of late anyway, and it's been a challenge over these probably last 12 months. But if they're starting to cement that and make it more based around law than policy, that can be really challenging, especially when there's an exception maybe for the right type of client or the circumstances in which clearly they could demonstrate why or how they could go above that. Being capped can be a little bit tricky.
Correct.
And the other one was around the LVR restrictions.
LVRs, yes. So you should know that one by now if you've been watching. So LVRs is your loan to value ratio. So at the moment, depending on if it's owner occupied or investment, if you're a first home buyer in the banks, general rule of thumb, owner occupied, let's say you can go up to 95%, investments generally around 90. There's a discussion around whether they start to pull that back as well. Okay, so obviously with the market being so high, there's not a huge amount of fat in that or room if it did cool down a little bit. So just wanting to put a little bit of equity and stuff in that. Interestingly, we have been seeing that the banks are offering very competitive rates for clients with larger deposit or equity at the moment, which is interesting. So it's sort of like 30% is the new 20. Yep. So there are new tiers around really, really sharp rates. So they're keen to be getting business where there's a bit more equity and fat in that. I'd say highly likely to do with the market being higher at the moment. So again, that's a topic of discussion or a potential option.
Yeah, and again, like you mentioned there, what they're trying to achieve out of that is making sure that they have that buffer. If the market does cool a little bit, why would they do that? Well, if the market cools a little bit, then suddenly we don't go from a 95% in a rising market to 105, 110, being upside down, owing more than the value of the property. So that's just sort of one or two examples of how or why that might happen. We saw good news this week because a lot of the cashback incentives or refinance rebates that have been put out there by the banks of late, most of those were due to stop on the 30th of December, and surprise, surprise, they have decided to kick those on, which is really exciting.
September?
Well, they were September 30 was where they had to be lodged by. So a lot of those had that D date, and then waiting till like literally a day beforehand, they all came back out and said for another sort of 90 days, they'll extend that. So an opportunity for clients to refinance, restructure, refinance, and pick up $2,000, $3,000 along the way. For looking and exploring the idea of changing to a new lender. So
absolutely. They're keen to do business.
If you had been exploring that idea and you've sort of been holding off, definitely that's still on the table. And $2,000 or $3,000 is a great way to intro to a new bank, and away you go. We also saw some other good news, just like all this good news. Oh my God.
But that's us. We're always good news.
The good news brokers.
Yes.
That's us. I like that. It's trending in lending from the good news brokers. Further easing for self-employed clients.
So a few weeks ago we were talking about the self-employed space and how we had some pre-COVID policy requirements, some COVID policy, and how some had decided to adopt that maybe as business as usual. Interestingly, one of the majors we've seen has pulled back a little bit, so a little bit more relaxed. They were wanting not only all of your tax returns but also BAS up to today, pretty much, to see what's happening in trading statements. So they have relaxed that policy off a little bit. So it's changing quite a bit at the moment. They're
definitely wanting to lend. They're getting a little bit of flexibility. I get it, common sense, responsible lending. They've still got the right to ask questions for stuff they maybe didn't put on the checklist.
And we've still got a huge part of the country in lockdown at the moment. You know, so you do understand. You do
understand why, but it's been good to see that is starting to unwind. On that note, hearing the good news that New South Wales and Victoria are starting to hopefully come out of this and will be very soon. So looking forward to that and wishing you guys all the best over the next couple of weeks where that starts the pathway out, I guess, if that's what we're calling it. So we'll keep you up to date with that from your good news brokers, obviously. Totally running with that. But for now, look, enjoy the long weekend. Anything that you guys want to know, reach out, let us know, and we will keep you updated. Cool. Bye for now.
Bye.
Bye.